Good morning. 2026 to see increased CRE buying activity. And it's a disciplined reset, not a speculative boom. And commercial real estate is entering a new phase in 26, and the signal is clear. Investors are buying again. But this cycle looks very different from the excess driven expansion of the past decade. Today's activity is defined by pricing discipline, conservative leverage, and durable cash flow, not aggressive assumptions. Now, for borrowers, developers, and investors, this environment creates opportunity, but only if capital is structured correctly. So let's look at investor confidence, and its rebuilding is the point. After several years of rate volatility and stalled transactions, confidence is returning. Nearly 95% of investors plan to acquire the same or more assets in 26, while 55% are increasing capital allocations to real estate, which is a meaningful jump from last year. So, what's driving the shift? Well, we're seeing stabilizing interest rates, narrowing bid ask spreads, and underwriting assumptions that finally pencil again. And in short, the math is mathing. It's working again, but only for deals with sound fundamentals. So, capital is moving selectively. And this is not a buy everything kind of market. Capital is flowing to well located, income producing assets where pricing has adjusted and the downside risks are understood. Now, from a financing standpoint, this is going to favor borrowers and investors who are going to present realistic rent growth assumptions and also structure conservative leverage, but geared more to those who focus on long term hold strategies. And lenders are active, but they're rewarding preparation and discipline right now. So let's look at where investors are buying in 2026. Well, geographically, investor demand remains concentrated in high growth and liquid markets. Dallas-Fort Worth remains the top U.S. market for the fifth straight year. And Atlanta continues to attract capital due to population and job growth. And San Francisco is reemerging as a selective recovery play. Charlotte and Tampa reinforce the strength of Sunbelt fundamentals. Now, these markets just mentioned offer liquidity, demographic tailwinds, and lender comfort, critical factors in today's environment. So let's look at some sector preferences, and really the point is back to fundamentals. Investor interest in 2026 is anchored in traditional property types with clear cash flow visibility. And multifamily remains the top sector. And industrial continues to benefit from reshoring and logistics demand. And retail attracts capital where tenant mix and pricing are just right. Now, office is still limited, but selectively returning for Class A assets in prime locations. Now, alternative assets remain niche as always, but as most investors preferred, they've repriced the core sectors with proven demand. Now, risk appetite is measured and not aggressive. Roughly 2/3 of investors are targeting value add and core plus strategies, seeking stable income with controlled upside. And opportunistic and distressed strategies are fading somewhat. And what we could see is some widespread fire sale pricings that fail to materialize, and lenders avoiding forced liquidations. And owners with strong balance sheets are going to hold assets longer. And this favors borrowers who can execute business plans without relying on heroic assumptions to get the deal penciled. So conservative leverage is going to be the new normal, is another takeaway. From a capital markets perspective, leverage discipline defines 2026. And most investors are holding debt ratios steady. And nearly half are willing to accept short-term negative leverage to make deals work. And the bet is on rent growth and refinancing, not yield compression right now. So what this does is it creates strong demand for structured debt, flexible terms, and lender diversification, areas where mortgage brokers bring more to the value to the table for you. So the bottom line is that 2026 marks a return to buying, but not a return to excess. And commercial real estate investors are re-entering the market with confidence grounded in improved pricing, disciplined leverage, but most importantly, long-term fundamentals. So for borrowers and investors, success in this cycle depends less on timing the market and more on structuring capital correctly from day one. And that, my friends, is it for the day. Please visit billrapponline.com to figure out how to get a hold of me. And I'd love to talk to you more about your situation.